Let's jump right in, shall we? Welcome to this explainer. Today, we're looking at something absolutely fascinating. How to take market fear, that thing that causes total panic, and actually turn it into a measurable, objective piece of data. We're literally going to talk about taking the emotion out of investing by tracking the emotion itself.
Seriously, what if fear itself became a tangible, readable indicator in the stock market? Imagine being able to leverage fear instead of just, falling victim to it. Most people run from fear, right? But the smartest investors, they actually measure it.
Because let's be honest about the reality of investing panic. We've all been there. The news channels are absolutely screaming. Markets are crashing, retail investors are losing their minds, and you open up your portfolio app and it's just red. Red everywhere. It's chaotic, it's confusing, and honestly, it's terrifying. When crashes happen, everyone just gets stressed out.
So, let's move to Section 1, Meet the Fear Index. VIX, it stands for Volatility Index. Globally, everybody just calls it the Fear Index. And here locally, we refer to it as the India VIX. What it does is measure expected market volatility, basically the expected ups and downs, over the next 30 days. And the cool part? It derives this data directly from option prices. The mechanics here are beautifully simple. Step 1. Investors get spooked by some market event and feel fear. Step 2. Because they're nervous, they scramble to buy protection for their portfolios using options. Step 3. All of a sudden, frantic demand causes option premiums to shoot up. And finally, Step 4, because those premiums are up, the expected volatility, the VIX itself, rises. So, nervous investors driving up option prices literally and mathematically forces the VIX to go up. It's a direct chain reaction.
Okay, Section 2, Decoding Market Volatility Levels. It's kind of like a weather forecast. Think of a beautiful, clear blue sky as representing a low VIX. Investors are comfortable, they're chilling, and the sun is shining on the market. But a storm warning, dark clouds rolling in, that represents a high VIX. That's when investors are fearful and bracing for a rough impact.
Let's get a bit more specific with the actual numbers. When the VIX is below 15, the market mood is generally super calm and confident. Between 15 and 20, that's just your normal, everyday market volatility. Nothing to worry about. But when it climbs between 20 and 30, fear is clearly ramping up. And when it crosses above 30, no way around it. That indicates high panic and deep market uncertainty. The index is literally translating raw market emotion into a neat numerical format for us.
Moving on to Section 3, the 2020 market crash. Let's look at a real-world example.
80 plus. Let that sink in. During the extreme global panic and lockdowns of March 2020, the India VIX didn't just rise, it absolutely exploded. Remember what we just talked about? Anything above 30 is high panic. So an 80-plus reading is absolute, massive, off-the-charts fear.
And this dynamic played out in real time. It was wild to watch. As the Nifty index crashed sharply downwards, the VIX exploded upwards, perfectly capturing that exact extreme fear. They moved in perfectly opposite directions, like a seesaw.
Now let's contrast that terrifying crash data with this, 12 to 15. During normal, stable, bullish market periods, the India VIX typically just hovers calmly right in this 12 to 15 range. Honestly, seeing that normal baseline puts the absolute madness of that 80-plus reading into stark perspective, doesn't it?
Right, Section 4, a tale of two investors.
So let's look at Investor A. Like most people out there, they saw the market crash, they panicked, stopped their SIPs, and completely sold off their investments just to stop the bleeding. But then there's Investor B. Investor B looked at the exact same data, saw the high VIX, recognized that fear was absolutely everywhere, kept their emotions in check, and actually increased their investments while things were cheap.
The absolutely crucial point here is what happened next. The markets recovered strongly in the following years, and Investor B benefited massively. Why? Because for the intelligent, rational observer, fear created opportunity. It's really that simple.
Which brings us to Section 5, Mastering Your Psychology. How do we actually use this? Well, here are the really practical uses of the VIX. First off, you use it to objectively understand market fear instead of just wildly guessing. Second, you use it to control your own emotions. Like when the VIX is super high, everyone else is panicking, and just knowing that helps you avoid panic selling yourself. Third, it helps identify those extreme volatility zones. And finally, it improves your asset allocation discipline. Basically, it acts as a much-needed behavioral guardrail for your whole portfolio.
So here is exactly how you should behave based on the data. When the VIX is in a low zone, your job is incredibly simple. Stay disciplined. Don't do anything crazy. When you see a rising VIX, okay, it's time to be a bit cautious. And when we enter an extremely high VIX zone, the biggest rule, avoid panic. This is precisely when those long-term opportunities might just be emerging.
Now, wait a second. I need to explicitly state a crucial point here. The VIX is not some magic prediction tool. It's not a crystal ball. It cannot predict exact market tops or absolute bottoms. It measures expected volatility, folks, not guaranteed future movement. It is a tool there to support your investment decisions, definitely not to make them for you.
To sum this whole shebang up, the core concept to remember is that the VIX is really just a fear thermometer. A higher reading quantifies that there is way more panic and uncertainty swirling around in the market. A lower reading quantifies more comfort and confidence. It takes the entirely invisible force of human emotion and slaps a hard, objective number on it.
So I want to leave you with a final thought to chew on. The next time the news channels are screaming and the markets are bleeding red, will you let market panic control you? Or will you be the intelligent investor who studies fear to find long-term opportunity? Remember, smart investors don't become part of the fear. They study it.
This conversation is for educational purposes only. Mutual fund and stock market investments are subject to market risks. Past market behavior does not guarantee future results. Please consult a qualified professional before investing.